reaction out of Joe. That's a wrap.
All right.
Sweet.
God damn, dude. We got into some lawyer mumbo jumbo in there.
Yeah, well, you did most of the talking, man.
Today we've got Russell Hedman as our guest. A little bit about Russell. He is a Denver native. He went to East High School. He then went to CU Boulder, got a degree in poli-sci, where he was, club champion in the wrestling?
An All-American in club wrestling.
An All-American in club wrestling. And after that, he went to Harvard Law, got a law degree, interned at law offices in Hong Kong and in Tokyo, got his first law job at Latham Watkins in New York City, and then moved back to Denver, where he's been working in the M&A group at Hogan Lovells in the Denver office. Russell, thanks for joining us on the show today.
Thanks, man. I can't say I expected to be invited as one of the first people on your podcast, but I'm really honored to be here, and I'm excited to talk with you guys.
Yeah, absolutely. Well, good news is this isn't a podcast.
Oh.
It's a video.
Oh no.
Yeah, there's cameras watching you, but that's all right. Hopefully, tell people why you're wearing the nets. Why you're wearing the Nets gear.
Yeah. This little thing.
Yeah.
This year I worked on the Brooklyn Nets sale to Joe Tsai, and that took most of the last year up and into the spring this year. And it's been part of my growing practice in sports and entertainment in the Denver office at Hogan.
Okay, so you're buying and selling businesses, but also narrowing an expertise in the entertainment world.
I wouldn't think of it as narrowing because I still handle the bread and butter of my work is still middle market M&A.
Okay.
But we got plugged in with some entertainment clients a few years ago. We did great work in the space, and you get to know some of the people who work in the league offices, and you get to know some folks in the ownership circles, and we're building a practice in that space now, and it's been really fun and exciting.
Okay. So in venture, we always have a hard time defining stage. In your world, what is mid-market?
Yeah, it's a pretty loose term, but you're thinking about companies probably over $100 billion in enterprise value, or $100 million in enterprise value, but under $1 billion. And people narrow that range or expand it depending on what they want to talk about. Mm-hmm. But you're not talking about huge companies where everybody expects that they would be public. At the same time, you're not talking about companies that haven't really established a successful business pattern yet. Mm. So you're talking about mature companies, but not giants.
Okay. So that's not most of our portfolio companies. In fact, I'll go to say that's none of our portfolio companies.
Yeah.
Our portfolio company. Yeah, we hope our portfolio companies will be there, which is why it's important they should watch this episode with you. Our companies are startups, right? They're figuring out how to become a $1 billion company, hopefully in the future.
That's one of the funny things I think about the private equity world, which is where I play all the time, and venture capital. Folks think about them as so distinct and separate, which in a lot of ways they are in terms of who the investors are in the various spaces and how the actors might behave. But then all of a sudden there's this collision of worlds where you have PE, where a company has grown to a mature stage business, and all of a sudden it's on a market for PE buyers, or PE buyers are starting to give them attention. And there's a lot of space for folks like who sit in my seat to really understand what was going on in these companies before we go to buy them. And there's a lot of space for folks in VC to benefit from understanding what buyers are going to be thinking, when they approach a business that's coming out of the VC world.
What do you say those PE buyers traditionally look for?
PE buyers are traditionally looking for a business that, actually, look, even in the world of PE, there are a lot of, there's a huge amount of variety.
Sure.
But really, you're looking for businesses that are generating earnings so that you can lever up the business, purchase it for as little money sort of upfront as you can, and then use the cash that the business is throwing off to A, fund the debt that you just borrowed to buy the business, but then B, think about what the expansion of that business looks like. And so that's why the PE world sort of revolves so much around M&A. Is a lot of folks, especially in the Denver market, funds here, take what's called a buy and build strategy. So they're going to buy a company, they're going to find acquisitions that look like they are complementary to the business. They could be horizontal or vertical or otherwise. And they're going to stack that together in what we call bolt-on transactions. And you build a big platform in the space and then you sell it.
Why would it make sense for them to sell it?
Well, the funds have to exit. So they, you promise your investors that you're going to make them a return in a certain amount of time. So you buy a business, you stack on acquisitions, or you improve it in whatever way you think is best, and then you take it back out to the market. You sell the business, and then you get you get the returns from that sale, and that goes to your investors. So that's sort of the life cycle. But funds are, you can imagine there's sort of perverse incentives that could start to arise there, right? Where you suddenly have to sell a business that isn't mature for sale yet. So I would say a lot of the funds that we work with anyway, they have flexibility in their fund docs. So if they need to hold on to a company, they can do it.
Do you find yourself more on the buy side or on the sell side?
It's an even mix because your clients go through cycles. But as far as like add-on acquisitions go, that is, once a private equity fund has bought a company in a space and they're going to expand that business, we're doing all buy side to build the company. But there are certain times they want to divest part of a company too. That could make sense for a lot of different reasons, but one of which could be they're going to divest a non-core part of the business. Okay. So we work sell side in those contexts, and then of course we have to exit the portfolio platform. So then we're sell side at the end of the cycle. So there'll be a fun private equity one day when you guys are doing all sorts of different investments. You'll have a 0G PE fund too, I'm sure. And so in years 1 through 3 or 1 through 4 or 5, you'll be buying portfolio assets like I was talking about, and then building them, and you'll be getting rid of them in years 5 through 7. So it probably looks a lot like a venture capital model does, but with probably a bit more of a condensed time frame.
Talk to us about you being on the buy side. What does it mean to have a non-sophisticated seller or vice versa?
That's the most kind of typical scenario that you come to when you're a private equity fund, is that you're looking at buying an asset either as an add-on or a platform, but typically with people who haven't necessarily done big transactions before. This might be their first, second, or third sale, and even if they've done more transactions than that, they're not living and breathing M&A. So we usually have a sophistication advantage, frankly, when we come to the table to buy out smaller businesses. Sellers use a lot of different tools to try to balance that out, but frankly, the best one for them is when they get sophisticated lawyers. So, there are times when we buy smaller businesses, they've decided to invest in getting good legal counsel, and that can really level the table. But there are other times when we buy family businesses from, the family lawyer, the guy who's been doing their estate planning for the last 20 or 30 years, and frankly that guy hasn't really done M&A transactions, so we have a lot of advantage in those situations.
Who would have thought a lawyer would think a legal advantage would give his client the edge?
I think anybody who's been in a vicious business lawsuit will tell you the importance of it. Everything that you do around a transaction, if your lawyers have done a good job, you probably will never know that they were there. And I say that because, our job is not just to give our clients the upper hand in a hypothetical fight scenario, but to create situations through our drafts, through the documents, that avoid conflicts for our clients. And if we're really doing our job well, we're also maximizing the value for everybody. And that's why I think, it's sort of tongue-in-cheek to say the lawyer says you should hire good lawyers. But the fact of the matter is you see so many small businesses go through the sale process with unsophisticated counsel and honestly suffer for it.
We think that sophisticated investors make the difference.
They do. But actually, I think the one thing that you can't really trade, lawyers won't solve for you, is having quality people. So if you are working in a business where there are people there who actually care about the business and care about the founders and care about what the business post-sale looks like, you find that people are able to find a lot more common ground and structure transactions that make sense. You do other transactions where it's a founder taking his company to sale, and essentially his investors are no longer very interested in his company at all, and they're mostly getting ready to collect their check the day that it comes, and they're very upset that they haven't closed yet. They're very mad that they haven't got their cash yet, and the founder may not be negotiating the best terms for, frankly, the business or even the investors at the end of the day.
So what's the difference look like when you have equally sophisticated and expert legal teams, but different expertise from the entrepreneurial side or the PE side?
You're saying when the clients have different sophistication levels, but the lawyers are of similar level. I mean, look, a lot of a good lawyer's job is educating the client. We do as much teaching as we do drafting, frankly. People walk into a transaction, a private equity fund is buying them out, and a typical feature of a private equity buyout is rollover equity. So rollover equity is when the fund is going to ask the management team to roll some of their equity in the business into the new combined business that is being bought by the private equity fund. And it makes a lot of sense for a bunch of different reasons, one of which is if you structure it right, you can defer taxes on the sale. So you don't pay taxes at the time that you roll your equity over on that equity. You pay that down the road. And that can be really appealing. And plus, it's important for the funds because they want to align their incentives with management, right? So to them, having management that cares about the equity, the outcome of the business and the value of the equity is super important to the private equity fund. But there are a lot of features of equity. I mean, we think of if you go, okay, I'm going to go buy some public share of Microsoft or something. Well, there's out there that, there's a market, it's liquid. You pretty much know what you're buying. You've got your share, when you can sell it, and it's like cash basically, right? I mean, it's a very liquid security. Flip that over to private company work. Your shares are completely illiquid, unless you've negotiated something special, like maybe a put right on your shares so you could force the fund to buy you out at some point. And then the shares might be subject to things like vesting. You'll see sometimes funds will try to push on the founders of this business or the management team selling the business like a vesting component to their equity. So they roll over into this new business and then they need to work there a certain amount of time before their equity vests. I think if you had a sophisticated legal team on the sell side, they'll be able to tell you that's not market, and they'll be able to explain to you what the risks are around having, imposing a new vesting schedule on some of your equity. If you don't have counsel who's done a ton of sale transactions, I don't really know how they'll be able to tell you whether that's normal or not. I mean, they'll probably read the agreement and make some comments, but they're not going to be able to say this doesn't make any sense and no one does this and I would take my business to a different fund and sell it if you guys are going to try to cram these terms on us.
So you said a term that we hear a lot, it's not market or it is market.
Yeah.
I mean, how do you determine and reinforce that? Because we see it used a lot from different legal teams in the negotiation process, and this isn't market or that is, and we tend to get a sense that it is more interpretive.
Yeah, that's, look, so I'll give you the good answer, then I'll give you the real answer.
Sure.
The good answer is use resources. So resources could be industry experts, but more often than not, there are studies out there, especially in the M&A world. Lawyers are a bunch of nerds, believe it or not, and there are people out there producing tons and tons of studies for the lawyers to read and rely on.
Are these resources that anyone has access to, or more the legal community?
Yeah, no, they're resources that most people have access to, but you need to know where to find them. So for example, a lot of the deal studies that are out there focus on public companies. Why? Because the information is publicly available, but that doesn't mean anything to middle market private equity transactions or private company transactions. But there are companies like escrow service providers or payment service providers. SRS Acquium is one based here in Colorado that does a phenomenal deal study where on a confidential basis, they gather all of the terms from their private company deals, thousands of deals, and they provide a resource where you could go online and check to see, you could even narrow it down. You could say, I want companies between this value and this value with these features in the transaction, and so what's a normal holdback on what's a normal escrow, for indemnification in that scenario, and it could give you a market judgment. But the real answer, the good answer is there are resources, and your lawyer will have all of them if you have a good lawyer. But the real answer is what does the guy in Wolf of Wall Street say? It's a fugazi. It's a fugazi.
I don't know.
What's market, right? frankly, it's all sort of made up, which is right. But
what's market when there's one buyer, right?
Right. What's market for selling it? What's market for selling an NBA team in a two-step transaction at the highest value for an NBA team ever sold? Right? Like, and sort of things lose their meaning, but a good lawyer will be able to use some resources to make compelling arguments around no one does this, it would never be done, here's why, and look at these. And that's sort of the conversation that goes on between the lawyers.
Interesting.
So that's when both sides have equal counsel.
Sophisticated lawyers.
Give us the juice, Russell. Give us the juice. What happens when one side is a little overpowering the other side?
Frankly, it depends on how far your clients want to take it. There are people who value doing even-handed transactions across the board. I'd say there are a lot of people like that in Colorado who are doing deals. Like the funds in town here are great, and they want to do deals with people in such a way that they get a good reputation for doing good deals because it's important to them to have a good deal flow. Yeah. On the other side of that, you have like the opening scene in Gladiator where like the Romans are like slaughtering the Germans, because they don't know how to use shields or, something like that. The fact of the matter is buyout agreements are complicated, even for lawyers who have been doing parallel or similar practices. Maybe, I've done deals against lawyers who are like bankruptcy lawyers or actually they're credit lawyers or something, but they've been assigned by their client to do this M&A deal, and so they're going to handle the buyout, and there's just enough moving pieces.
Give us an example.
Well, it's like lawyer stuff, so it's going to be nerdy.
Let's get nerdy.
You're okay with that?
Sure.
Yeah.
Okay. Let's get nerdy.
This requires just telling you guys a little bit about how a buyout agreement is structured.
Okay.
The 60-second version is you make a set of promises about the state of the business called reps, okay? And then there are covenants, that's promises to perform something. But so you have your reps, that's like, imagine I was selling this chair. I would say the chair has 2 functional arms on it, and that would be a rep, right? And then later in the agreement, there'll be an indemnification section. And what that will say is if one of those arms isn't working, then the seller is going to make that right. He's going to pay the buyer for the fact that he was lying in one of his promises, right? But what happens is, nobody likes to make you're talking about large businesses here, right? Businesses with hundreds of employees and operations in different places. People don't like to make a flat rep that says, no window on any facility in our whole business is broken, right? So what we'll say is, the assets are in materially good condition. The word material means, to the level. What it technically means is it wouldn't affect the investment choice. That is like there might be some broken windows, some things might be a little messed up, but you would still buy it. It wouldn't have changed your mind. So you say my assets are in materially good condition. Okay, so that's the idea. Okay, in the back, further into the agreement, you'll see what's called a materiality scrape. Okay, what a materiality scrape will do is it will say, when we're trying to figure out whether damages have been assessed or not, just ignore the word material when it pops up in the agreement, because what we're going to do instead is just impose a deductible. So there'll be we'll just say we're not going to pay until it reaches $100,000. Don't worry about the word material. Who knows what that means anyway? We'll just have a deductible. Okay, so what will happen with an unsophisticated lawyer is there'll be a scrape in the back of the document. So the word material is ignored for all of these purposes of indemnification throughout the document. But these guys will spend all of their negotiating capital trying to say, my client could never promise that there are no broken windows. I will say the windows are materially unbroken. And like on our side, we have it on mute, and we're like, does he not understand how the thing works? And then we're like, okay, here, let's try. And we unmute it and we say, well, man, we can't do with the materiality and the broken windows, but, if you gave us that other thing that actually matters in the context of this document, we'll give you all the materiality qualifiers that you want. But that's real. I mean, that's how it works. That's the problem is that guy just hasn't gone through those documents 100 times to understand that there are 40 different pieces that break down into a real risk profile for his client. And you end up seeing sellers sometimes who have a large part of their purchase price clawed back by the buyers because there were things that were wrong in the document and their lawyer didn't really understand how it all worked together. So look, if anybody followed that who's not a lawyer out there, good for you. It's complicated and even lawyers miss it. But the fact of the matter, I guess the headline is that buyouts are tricky, and if the business isn't what people expected after they've bought the company, they're going to come back to the sellers and look to claw back some of their money. And if your lawyer didn't protect you, there's no way out of it. You're going to end up giving up some of your purchase price.
Can a lawyer protect me from the IRS?
Not me.
Not this lawyer.
Yeah, not this lawyer. I can't protect you from the IRS. I mean, no, but look, a good firm will have specialists in all these different areas. I mean, one of the big ones right now, one of the big topics on everybody's mind is GDPR. And what that means for what the privacy regulations are gonna mean for businesses going forward who are working especially across international borders. If you're working with lawyers who can't really advise you on that, by the way, a lot of lawyers will tell you that they can, right? But if you're not working with people who can actually help you understand what the implications of GDPR are, you may find yourself in a sales scenario where your lawyer has promised something like, my business is in material compliance with all privacy regulations, and then you end up with a bunch of your purchase price getting clawed back.
So Russell, you brought up a really good point. We always encourage our entrepreneurs to run lean.
Yeah.
It's in their best interest.
Yeah.
How do you balance adequately building up a war chest to be assigned for legal activities and with just wasting capital on legal activities that won't yield any fruit, essentially?
That's a really hard... That's the trick that a good GC has mastered, right? A good legal counsel in a company has really learned to balance risk assessment with his spend. It's tough, though. What I would say is, if you have lawyers who are actually invested in your business, I don't mean financially invested, but people who really care about what you're doing and they want a good outcome for you, first of all, they're going to work with you on whatever the spend is, right? They're going to say, like, look, how much do you guys need to spend on this? And they'll come up with a legal strategy that will fit your needs more or less. And then as soon as you start to get out of bounds and do something crazy because you think you don't need lawyers for it, they're going to flag it for you. Mm-hmm. And there are a lot of times where, like, we have clients who are on a tight budget, and, I would prefer to use our tax guys, but actually they have EKS&H involved on something else. And I can use the EKS&H guys to, help us get some tax provisions right, and maybe we don't need to use our lawyers. But if it wasn't somebody, if you imagine you had a lawyer who doesn't really care about you, they're more going to be focused on trying to rack the fees up, frankly, because that's our business, right? The same way your guys are out there trying to sell, rocket ships or inventions that change the world. Lawyers are out there trying to sell legal services. So you need a lawyer who's going to act like a partner for you, like a lawyer who's going to look out for that.
What happens on your end when someone tries to negotiate a fixed fee?
Depends on the scenario. Law firms have to be flexible now. I have never worked on a fixed fee assignment, but I've bid on projects where we put a cap on our fees. Mm-hmm. I got to say, though, in the buyout scenario, you have to be very thoughtful about what that really means for you. Because at some point, if your lawyers have gone way over whatever they would have billed you, they're going to get pressure from their firm to turn to other projects. And you might be in the last stages of your transaction where you really need the lawyers to pay attention. So, for example, I did a buyout of a venue some time ago, a big party venue in a big city. And their lawyers had hit their fixed fee limit sometime early in the transaction. Well, in the second, between signing and closing on that transaction, a bunch of things went wrong. They had to push out closing a full year. These lawyers, we couldn't get their lawyers on the phone to do anything. And basically, they ended up with $100,000 in indemnity claims for stuff that was easily handleable by their counsel, but their counsel wouldn't do it because the counsel wasn't getting paid. These guys, I don't think they're great lawyers, but they preferred to let their client get it wrong, and they preferred to let their client pay for it in purchase price instead.
So, Russell, we've talked about the value add that lawyers can bring to a deal. Let's talk about other partners, including investors, and how they can help even the playing field and make sure there's not only good terms at future financings, but also at an exit.
Yeah. For folks who haven't done a transaction before, it's often hard to understand on the sell side what the buyers really want. If you're working with a principal on your side, or maybe an investor on your side who has sat in some different seats and in the investing world and really understands what the incentive of the different players are, they can help maximize value by getting the focus away from things that the buyers don't care about and getting the focus onto things that the buyers do care about. And you see some value pop out of nowhere when folks are really aligned like that. So I have an example, which I told Sasha before, which was we were working on a sale, a specialty manufacturing business, and it was like a $500 million business. But what the investors on the sell side realized is that the buyers were only valuing a part of the business. In fact, there was a wing of the business that wasn't really cash generative, wasn't throwing off cash, that the investors on the buy side really didn't care about at all. Because we were talking about, just like we were talking about earlier, the private equity funds are thinking about buying businesses that are throwing off cash. Mm-hmm. So this section of the business, this division of the business, wasn't throwing off cash. Frankly, the private equity buyers on the buy side really could not care less at all about that wing of the business. So one of the sell side investors had the idea: can we spin that side of the business off before we make the sale? So we're already mid-transaction when the investor realizes this.
How did that negotiation work?
It went like this. We asked them to resubmit their bid for the business. Once they understood what was happening, they asked to resubmit their bid for the business. The buyers resubmitted the bid, and they asked them in the bid to speak to what parts of the business they were actually talking about and to place values on different parts of the business. So, for the manufacturing facilities in Asia, we'll pay this much, and we value this part at this much, and these contracts at this much, and so the total purchase price is, I think it was like $525 or something like that. And by the way, we put a zero on this part of the business because we don't think that's really ever going anywhere. So then the sellers came back to the table. They said, okay, we hear your $525. I think we'll take it, but we need a chance to spin off this business underneath the business.
The ones that you put zeros on.
The one you put, there's a big one, you put a zero on. We're going to take that before you guys buy it. And they said, I don't understand how you're going to do that in the time frame that we've all agreed to, but sure. All of a sudden, I was doing one transaction. Now I was running 2 sale transactions, except that one of them had to happen so fast that the business that was being spun out could close before the closure of the big sale. The thing was, the investors on that side, they knew all the players in the market around this specialty manufacturing that had been valued at zero. So they already had a buyer in mind. They already knew exactly who to go to. It was actually some of the founders of that business back in the day who they had bought, that business from a decade ago, and some of their capital partners. And they ended up finding a buyer group, and it was a PE-backed management team who totally understood the scenario. Knew our guys, trusted them, was willing to work with them, and they sold this business off for $120 million before they sold the $525 million business.
Wow.
And the transaction turned out to be a home run. It was already a good sale at $525. Look, I think everybody knows that transaction. It was a special transaction. But that's the kind of thing that if you were just a seller who sees your business as a single unit and you're devoted to it and you've been building it and you've been creating it, you might not necessarily think like there's $100 million just waiting here for me to unlock if I'm willing to say this part of the business sells off differently. Mm-hmm. I'll tell you something interesting. So a lot of the management, look, it's hard to split up a business if you love it, right? And so people had some mixed feelings about it. A lot of the managers, who were going to go on with this 525 big side of the business, were like, I don't know about splitting it off. What's interesting is it gave them options. So a bunch of those managers went to work here, didn't like working for those guys, and then they just went back and worked on the other side of the business that had been sold off. So, I have to think everybody sees that as an extremely positive outcome. And that was possible because there were investors who knew what the other players in the deal cared about and didn't care about.
Mm-hmm.
So Russell, venture-backed companies accumulate a ton of losses over the years, right, before they exit.
Right.
And that's of huge value to a buyer in certain situations, right?
That's right.
Because of the tax benefits. So give us some examples and walk through with us how that works.
I think if you have people working on your sell-side deal who don't understand what a tax asset is and in what scenarios they might be valuable to buyers, you could totally miss the value of your tax asset. So, like you said, venture businesses accumulate losses. We call them NOLs or tax assets. And
what is an NOL?
Net operating loss.
Okay.
And what it means is basically the government gives you a tax credit if you're spending more money on your business than you're making, which is the scenario of all venture-backed businesses pretty much, right? And so what happens is you build up a tax asset in the business. And you have a buyer who comes and they're going to buy that business and maybe roll it into a bigger business or roll it into a bigger investment portfolio. If the buyer can, those businesses transfer to a buyer. Those tax assets, they transfer to a buyer of the business. So if the buyer of the business can use those tax assets to apply it against gains, or by the way, if the seller could use them, if they could apply it against the transaction taxes, or if there are other applications for the tax assets, then it's just as good as cash. So you'll see sophisticated sell side, sophisticated folks working on the sell side will take the tax assets out of the standard pricing model. They'll say, please price this business based on its revenue. Tell us the multiple you're willing to pay for the earnings of the business. And then they'll say, and please fill in this blank and tell us how much this tax asset is worth to you. And sometimes there are buyers who will look at the tax asset and they don't have an application for it. It's not worth anything to them. There are other buyers who know right away that they can apply and use that tax asset, and they'll write a price down and they'll add that to the purchase price they're willing to pay for the business.
What's the standard price for that?
There isn't a standard. Because it has to do as much with what the buyer's situation is as the seller's situation. So one very normal thing you'll see is buyers will say, look, we recognize that there's value in these tax assets, but we don't know yet as a practical matter whether we can use them or not. So we'll pay you post-closing based on the value actually realized. So buyer will, take the tax asset, attempt to use it. If they do use it, the sellers will get paid. If they don't, then no additional purchase price goes to the sellers. You also see people pay a flat purchase price for it because it's easier, or because they know for sure that they can use the tax asset. But it's there as an asset in the businesses, and if you run a sale process without at least exploring that set of cards, you're just leaving something potentially on the table.
Anything else you'd like to share with our audience? Maybe you can tell them how important it is to hire an attorney from Hogan Lovells.
Wow, that was shameless. But look, if you're in Denver and you want a sophisticated M&A team, please come talk to us. We do work all over the world and with companies of all sizes, and we're right here in town. So if you're thinking about doing a transaction, come talk to us and see what we have to say.
Now, if a company hires you, can they require you wear their swag for the next year? Is that part of the deal?
The first company that hires me and refers to this podcast, this video cast,
yes.
Every time I subsequently appear on this video cast, I'll be wearing your shirt.
Oh, okay. Well, thanks for coming on, Russell.
Yeah.
Thanks,
Hey,
Russell.
thank you guys.